72%.
Yeah, that is a wild number.
Right. I mean, that is the percentage of highly successful professionals, like people with 30 or more years of corporate experience who step into the open market and have absolutely no idea what anyone would actually pay them for.
Done it all.
You spend 3 decades, building this incredibly valuable reservoir of knowledge. You step out of the corporate machinery and suddenly you're just standing there feeling like you're speaking a language nobody understands.
It really is the ultimate professional disconnect. I mean, you have decades of proven capability, right? A track record of navigating these complex disasters. Yet the broader market just seems, well, completely oblivious to your value.
Exactly. And welcome to today's deep dive, by the way. We are unpacking a really fascinating dynamic today.
For sure.
We're specifically looking at how you, the listener, if you're a professional over 50, can successfully turn those decades of corporate experience into a highly profitable second act business.
Right, without risking your retirement security.
Exactly. And we're drawing our insights today from an article by Kurt Rose on his platform, Retirepreneur, which is dedicated to exactly this, helping that 55-plus demographic build consulting and coaching practices.
And our mission for you today is to, well, dismantle a very pervasive, very dangerous illusion.
The resume illusion.
Yes. There's this assumption that a pristine corporate resume just automatically translates into entrepreneurial success.
Which it definitely doesn't.
It really doesn't. So we're going to reveal the specific, like the mechanical translation steps required to convert your history into an offer that clients will actually write a check for.
So let's start with that staggering 72% statistic from the Retirepreneur Community Survey, because to me that highlights a massive psychological hurdle.
Oh, massive.
Like, why do highly experienced, undeniably competent professionals struggle so hard just to articulate their value to a first client?
Well, the root of the struggle is that they're treating it as a capability problem.
Okay.
When it is entirely a translation problem. Like, the mistake professionals make when approaching their late 50s or early 60s is thinking about their expertise in terms of job titles.
Right. And historical responsibilities.
Exactly. But the market does not buy job titles. The market buys solutions to highly specific, immediate problems.
So saying, I have 25 years in financial services is essentially meaningless to a buyer.
It carries zero weight.
Yeah.
Because it doesn't address the buyer's pain. I mean, a professional who spent 25 years in finance didn't just master the abstract, academic concept of finance.
Right.
They mastered cash flow crises. They mastered acquisition due diligence. They navigated bank covenant negotiations when a company was, like, right on the brink of default.
Yeah, those are tangible, terrifying problems.
That still exist in the market today. People are actively losing sleep over those exact crises right now, and they will pay a premium for someone who has already walked through the fire.
Let me push back on that, though, because if you're listening to this and you have 30 years under your belt, doesn't focusing on just a few specific problems completely ignore, 90% of your massive, impressive background?
Feels like it, yeah.
It feels a bit like trying to sell a top-of-the-line Swiss Army knife, but only telling people about the toothpick. Why wouldn't you advertise the whole tool?
I love the Swiss Army knife analogy, but we really have to separate the past from the future here.
Okay, how so?
Well, a resume is a historical document.
Right.
It catalogs your past responsibilities to satisfy a corporate HR department. But a business offer is a promise of a future result to a buyer who is currently in distress.
Ah, okay.
The source material challenges you to do a very targeted exercise. It says, look back through your career and identify the top 5 problems that consistently landed on your desk when things went fundamentally wrong.
So not the daily duties in your job description.
No, the 5 alarm fires. The moments where someone in leadership decided you were literally the only person who could fix it.
So the pattern of crises you solved actually becomes your marketable product.
Yes. The key shift is moving from describing a background to promising a result. Like telling a CEO, I have 25 years in accounting, gets a polite nod, and maybe they forget your business card.
Right.
But telling a CEO, I help manufacturing companies pass their first external audit without any surprises or penalties.
Yeah.
That makes them lean forward.
Because one is a passive background and the other is an active lifeline.
Exactly.
So if the psychology of specific positioning is the lifeline, why do so many smart professionals immediately dilute that positioning? By casting a ridiculously wide net.
It's the natural impulse.
Right. Once you know what you do, you want to offer it to as many people as humanly possible to increase your total addressable market.
Yeah.
But the retirepreneur piece argues this broad approach is actually the fastest way to fail.
It is, and it feels incredibly counterintuitive to the first-time founder. I mean, the logic seems sound, right? More potential clients equals more options and less risk of missing an opportunity. But broad positioning actually renders you totally invisible in a crowded marketplace.
Let's look at the positioning formula from the text because I think it illustrates this perfectly.
Let's do it.
So the formula is I help, and then specific audience solve specific problem so they can specific outcome.
Right, and every single word in that formula is a critical economic decision. Compare the broad approach to the specific approach. The broad approach is, I help businesses with financial planning.
Which is everyone.
Do you know how many people that describes in the U.S. alone? Hundreds of thousands.
Yeah, you're competing with everyone from a local bookkeeper to massive consulting firms.
Now compare that to a highly specific approach. I help SBA lenders structure loan portfolios that hold up in federal audits.
Wow, okay. That is super specific.
Right. The Small Business Administration has incredibly stringent guidelines, and an audit can result in massive financial clawbacks for a lender. So that describes a highly specific person solving a high-stakes problem.
So when a stressed SBA lender reads that sentence, they don't see a consultant. They see a painkiller.
Exactly.
Yeah.
And the financial data backing this up is wild.
Yeah, let's talk about the data. According to a study by Consulting Success looking at nearly 1,000 consultants, 66% of specialized consultants charge at least $10,000 per project.
Which is huge.
But among generalists, only 18% ever hit that mark.
And specialists are also twice as likely to use value-based pricing, which, consistently beats hourly billing.
I actually want to pause on value-based pricing because transitioning out of a salaried mindset into an hourly consulting rate is a total trap. I see a lot of people fall into it.
It's a huge trap.
Explain the mechanics of why hourly billing penalizes the 55-plus professional.
Well, when you bill by the hour, you are literally penalizing yourself for your own efficiency and your own expertise. Think about it. If you've been solving a specific type of, say, supply chain bottleneck for 30 years, you might be able to diagnose and fix a company's million-dollar logistics issue in, 10 hours.
Right, because you've seen it 100 times.
Exactly. So if you charge $200 an hour, you make $2,000 for solving a $1 million problem. You just captured a fraction of a percent of the value you actually created.
Wow. Yeah, you're artificially capping your income based on the clock.
With value-based pricing, you price the outcome, not the time. You agree with the client that fixing the bottleneck is worth $1 million to their bottom line, and your fee to facilitate that outcome is, say, $100,000.
And the niche makes this possible. Because a generalist just doesn't have the specialized authority to anchor their price to that ultimate value.
Yep. And it also completely changes the psychology of referrals.
Oh, that's a good point.
Think about it from the perspective of your network. If you're a general leadership coach, your former colleagues don't really know when to recommend you.
Right. They might introduce you to someone who just needs to complain about their boss over coffee.
Exactly. It's vague. But if you are the SBA lending audit specialist, your network knows the exact trigger event.
Yeah.
The second they hear a lender mention an upcoming audit, they give you a targeted, high-value introduction to someone holding a checkbook.
Because you want to be the exact key for a very specific lock.
Precisely.
So let's look at the operational side of this. You have your specific problem, your specific audience, and your positioning statement is dialed in. Now we hit the delivery wall. How do you actually package and sell this expertise?
This is where seasoned professionals often get completely derailed by internet trends instead of proven business structures.
Yeah, the internet is completely obsessed with passive income.
Totally.
Every marketing guru is shouting that you need to build a scalable online course or a paid community or some cohort-based training program.
Right. But Kurt Rose argues strongly that for a 55-plus professional starting a second act, a course or community is the absolute worst place to start.
The worst.
It is a massive structural trap. The delivery model you choose shouldn't be based on a lifestyle preference for passive income. It's a decision about economic utility and your risk profile.
Okay, let's break down the three models mentioned: consulting, coaching, and courses. But let's focus on the economic leverage of each.
Sure. Let's start with courses and communities since they're heavily promoted. Courses require you to package your knowledge so it transfers without your real-time involvement.
Right, passive.
But the problem is they require massive upfront capital. in the form of your time to create the curriculum, shoot the videos, build the platform, and more importantly, they require distribution leverage.
Meaning you already need a massive audience to sell them to.
Exactly.
It's kind of like writing a highly technical 400-page textbook for a university class that hasn't even been enrolled yet. You're guessing at the syllabus instead of just tutoring the one student who is currently failing the subject.
That is the perfect way to look at it. You're assuming you know exactly what the market wants to learn before you've ever tested the material.
And consulting is the opposite.
Consulting is the polar opposite. Consulting has high active leverage and requires zero infrastructure. A client is hiring your judgment to execute a solution on their behalf.
So it's the fastest path to revenue.
Fastest path, bar none. Because you leverage your existing expertise directly into the market. Coaching sits in the middle. Really, you guide the client's development so they can do the work themselves.
This brings us to a really fascinating psychological barrier mentioned in the source material, the CPA instinct.
Oh, I love this concept.
Yeah. Why do incredibly smart, analytical people like former executives suddenly sabotage themselves right at the starting line, like by ignoring consulting and trying to build massive, complicated systems?
So the CPA instinct, which is referencing the stereotypical risk-averse nature of a certified public accountant, is this deeply ingrained desire to research, understand, and map out 100% of the landscape before taking a single action.
Because in a corporate job, especially in leadership roles, mitigating all risk before acting is heavily rewarded.
Right. You're trained to demand to see the whole picture before moving forward.
So that corporate conditioning is actually the enemy of early-stage entrepreneurship.
It's fatal. Applied to starting a second-act business, this instinct produces incredibly detailed 40-page business plans.
Beautiful financial projections.
Yes. Slick websites, exhaustive competitive analyses, and absolutely zero clients.
Wow.
You're basically hiding behind preparation to avoid the vulnerability of actually pitching your services.
Hiding behind preparation. That is a brilliant way to frame it. So the cure for the CPA instinct is to force yourself to strip away the infrastructure entirely.
Yes.
No website, no LLC formation yet, no logo. Just find one client with one specific problem and offer to solve it for them.
One specific offer, one specific client, one project, because that generates real-world localized feedback.
Did the client value the solution? Did the pricing make sense?
Exactly. That initial consulting engagement provides data that is just infinitely more valuable than months of hypothetical market research.
Okay, so we've covered the mechanics of how to translate the experience and how to deliver it. But if you're listening to this from the comfort of a late career salaried position, I think the lingering question is whether walking away from that steady paycheck is actually financially responsible.
It's a fair question.
Let's look at the hard data regarding the financial reality of the second act.
Yeah, and the financial reality is much stronger than the cultural narrative suggests. Like, the narrative tells us that entrepreneurship is a young person's game. But the data completely contradicts that.
The Kauffman Foundation data proves it's not some fringe movement. The 55 to 64 age bracket is an exploding demographic.
Exploding.
Between 2015 and 2024, first-time founder applications from that specific age group jumped 35%. They're outpacing every other demographic in new business creation.
It's this massive realization by seasoned professionals that their expertise has immense independent market value. But the National Bureau of Economic Research, the NBER, provides the most eye-opening insight here.
What did they find?
They tracked IRS and Social Security administrative data, and they found that the average self-employed professional at age 55 earns approximately $134,000 annually.
Okay, and how does that compare to the peers who stay in traditional corporate roles?
Comparable salaried peers are making about $79,000.
Wow.
So you're looking at roughly a 70% premium for the self-employed professional. And the researchers noted the real gap is likely even larger, due to the tax advantages and deductions available to the self-employed.
I want to break down the mechanism behind that income gap, because why is a self-employed 55-year-old making $134,000 while their corporate equivalent is capped at $79,000?
It really comes down to corporate overhead and internal HR bans.
Okay.
In a corporate environment, a director of finance might generate $300,000 worth of value for the firm, but their salary is capped by internal equity, like what the other directors are making.
Right. Plus the benefits load.
Exactly. The cost of the office space, the profit margin the firm demands to keep. But when you transition to a solo consulting practice, you strip away all that corporate overhead.
You capture 100% of the margin you create.
Exactly.
But are these NBER numbers skewed by, like, a few massive tech exits in Silicon Valley? I mean, is 134 grand really the reality for the average solo consultant who just nails their niche?
Well, the upside is indeed concentrated, but it is not concentrated in tech unicorns.
Okay.
It's concentrated among people who build true expertise-based businesses, rather than people picking up, say, gig economy side hustles.
So it's the difference between consulting on global supply chain logistics versus driving for a rideshare app to make extra cash.
Precisely. And if you look at ZipRecruiter's labor market data for independent business consultants, the average sits around $99,000 a year, with the top quartile hitting between $140,000 and $155,000.
So these aren't statistical outliers?
Not at all. These are the exact people we've been discussing. The ones who made a specific offer to a specific market and utilized value-based pricing.
So the defining variable for hitting those higher income tiers isn't just surviving 30 years in an industry. Experience alone doesn't guarantee the premium.
No. The income gap between a generalist struggling to make 50 grand and a specialist making 150 grand is almost entirely a function of their positioning.
Yeah.
It's the ability to walk into a room and confidently say, I solved this one expensive problem faster and better than anyone else.
It all circles back to the translation problem. If you can translate your historical resume into a future result for a highly specific buyer, the financial upside is incredibly compelling.
Building this second act is a very deliberate process. It starts with identifying those recurring crises you've solved.
Right.
It runs through writing that hyper-specific positioning statement to attract a niche audience. And it ends with fighting the CPA instinct, putting the business plans away and getting one client to pay you for one solution.
Yeah, because everything else, the scalable courses, the coaching communities, the passive income, all of that is built on the foundation of that first successful consulting offer.
Exactly.
To recap the journey we've been on today, step 1, stop selling your job titles. The market buys solutions, not resumes.
Right.
Step 2, embrace the counterintuitive power of the hyper-specific niche. Shrinking your total addressable market is how you become visible, how you get targeted referrals, and how you justify value-based pricing.
Absolutely.
Step 3, fight the urge to hide behind preparation. Don't spend 6 months building a complex online course in a vacuum. Go find your first consulting client.
Just go do it.
And finally, trust the data. Your decades of expertise are highly valuable, and stepping out from under the corporate HR bans allows you to capture the true margin of your worth.
As we wrap up today's deep dive, I want to leave you with a different way to look at the value of your career history, because we spend so much time worrying about whether our technical skills are up to date.
Especially with the rapid advancement of artificial intelligence and automation, it's a huge anxiety.
Right. People wonder if an algorithm is going to make their 30 years of process knowledge obsolete.
Yeah.
But here's the provocative reality you need to consider. Technical knowledge is rapidly becoming a cheap commodity.
Interesting.
The market no longer pays a premium for just knowing the answer. An AI can find the answer in seconds. What the market pays a massive premium for is human judgment.
Wow, yeah.
It pays for wisdom. It pays for the pattern recognition that only comes from having your boots on the ground during 3 decades of corporate disasters, market crashes, and complex human negotiations.
Because an algorithm can tell a CEO what the financial data says, but an algorithm cannot sit across the table from a panicked executive, look them in the eye, and tell them exactly which lever to pull to save the company based on hard-won experience.
Exactly. Your greatest asset isn't your techno knowledge. Your greatest asset is your seasoned judgment.
The only question is whether you are ready to start charging for it.